All right, we've got a new tech company heading for the public markets. LOGICIEL Solutions, a software development firm with really deep roots in the US market, is about to launch its IPO. So today, we're going to do what we do best, crack open their prospectus and see what's really going on under the hood. So the big question on every investor's mind is pretty simple, right? What's the real deal here? Is this a hidden gem, a high-growth opportunity, or are there some serious risks we need to think about? Well, let's find out. We're going to dig into the numbers, the strategy, the whole shebang. Here's how we're going to break it all down. First, we'll look at the company's main pitch. Then, we'll decode their business model to see how they make money. We'll check out their growth plan for all that IPO cash, uncover any potential red flags, meet the management team, and finally, we'll get to the big one, the valuation verdict. Okay, let's dive right in. First up, who exactly is LOGICIEL Solutions? What's their story? So, in a nutshell, they're an offshore software development company. That just means their team is based in one country, in this case India, while most of their clients are in another. This lets them be really competitive on price. They build custom digital products for other businesses, and they're focused on all the hot-button areas right now: cloud, AI, app development. You can think of them as the expert tech team a company hires to bring its digital vision to life. So that's what they do. But to really understand if this is a good investment, we've got to follow the money. How does this company actually make a living? Whoa. Okay, the first thing that just jumps right off the page is where their money comes from. Look at that. Almost all of it, over 96%, comes from one single market, the United States. Now, this intense focus has obviously been great for their growth, but it also means their entire business is pretty much tied to the health of the US economy. And believe it or not, the concentration story doesn't stop there. When you look at the industries they serve, one sector is just dominant. Nearly 70% of their revenue comes from clients in the home improvement and construction industry. Now, being a specialist like this can be a huge advantage. You become the go-to expert. But it's also a big risk, right? If that one sector takes a hit, their business could feel it in a big way. This brings us to the absolute heart of any IPO. Why are they raising all this money from the public in the first place? Let's take a look at how they plan to spend your potential investment. The company is planning to deploy just over 14 crores, or 143 million rupees. Now, for those of us not used to the Indian numbering system, a lakh is 100,000. So we're talking about roughly 1.7 million US dollars. It's a significant amount of cash that they believe is going to fuel their next big growth spurt. And this chart really tells you everything about their priorities. The single biggest piece of the pie is going to hiring new people. That makes perfect sense. For a services company like this, your people are your product. So more talent means more growth. The next biggest chunk is for upgrading their IT infrastructure, and the rest is for sales and marketing. It's a classic playbook. Get more people, give them better tools, and tell more customers about it. All right, now for a really crucial part of our analysis. Every single investment has risks, and companies are legally required to tell you about them. So let's look at the key red flags that LOGICIEL Solutions has highlighted themselves. The first major risk, and honestly, it's a big one, goes right back to those revenue charts we just saw. The company has what's called heavy customer concentration. It's a fancy way of saying they have way too many of their eggs in just one or two baskets. And the numbers on this slide are pretty staggering. For the last fiscal year, one single customer was responsible for over 62% of their total revenue. Just let that sink in for a second. And their top 5 customers, together, they made up more than 86% of all their sales. This level of dependency is a huge risk. If they lose just one of those big clients, it would have an absolutely massive and immediate impact on their bottom line. The second key risk is just as important. It's the company's huge reliance on its promoters, which is another word for the founders. In the investing world, we often call this key person risk, and it basically means the success of the whole company is tied to just a handful of people. And you don't even have to take my word for it. This quote is pulled directly from their own prospectus. The company itself is telling you, hey, our success is deeply, deeply tied to our founders staying involved. They've been the driving force, and the business really depends on them sticking around. Now, beyond those two big ones, the prospectus lists a few other, let's call them housekeeping risks. Things like having some past delays in paying their dues, some minor mistakes in their corporate paperwork, and the fact that their company logo isn't even a registered trademark yet. Individually, these might seem small, but when you put them all together, they could point to some operational kinks that really need to be ironed out as they become a public company. So, given that huge reliance on a leadership team, it is absolutely essential that we take a closer look at who they are. And what you see right away is that the promoter team is very much a family affair. It's led by the managing director, Mr. Umesh Sharma, and he's joined by other family members in key roles. Now, while they definitely have experience in the IT industry, investors need to understand that this family-led structure means that all the big decisions and the entire company vision are concentrated within a very small, tightly knit group. And that brings us to the final and probably most important question for any potential investor. What about the price? Let's talk about the valuation. So let's put them up against their competitors who are already listed on the stock market. Using a key metric called return on net worth, which basically just measures how efficiently a company uses shareholders' money to make a profit, they actually look really strong. At nearly 33%, they're more profitable than their peers. That's a huge checkmark in their favor. But of course, there's another side to the valuation coin, the price to earnings, or PE ratio. This tells you how much investors are willing to pay for every dollar of profit the company makes. We don't know LOGICIEL's exact PE ratio just yet, but we can see the industry average is around 36. So the key question is going to be, when that final price is announced, will LOGICIEL be a bargain compared to its peers, or will investors have to pay a premium price for that higher profitability we just saw? So this is really the core dilemma, isn't it? This is what it all boils down to for anyone looking at the LOGICIEL Solutions IPO. On one hand, you've got this very profitable company with a clear plan to grow. But on the other hand, you have these massive concentration risks tied to one country, one industry, and just a few customers. So the final question is one that every investor has to answer for themselves. Does that growth story outweigh the risks? And ultimately, is the price right for you?